Hi guys, this is Viper with $1 stock picks. I want to go over planning your trade based off your stop loss. And most people, whenever they're trading, they focus on so much coming at them, volume and, entry and moving averages and VWAPs and all that, but risk, how much you're risking, really is probably your biggest thing you should worry about. So with that, I'm going to get into some math that'll help you plan your stop loss in advance. Now, your stop loss is based off of not how much you invest, dollar amounts. So say you have $1,000, it's not based off of $1,000. It's based off how many shares you're able to buy at the price of the stock at the time that you're buying it. So say you have $1,000 and you need to use that $1,000 to buy a $5 stock. So we're going to divide that by 5 and you get 200 shares. Now, your stop loss, this is how you calculate your stop loss on how much you should give yourself in leeway room based off of how much you want to lose of that $1,000 or gain of that $1,000. So 200, we're going to start off in a small increment and we'll work our way out because we're going to work in cents, like pennies. So if you think about it that way, a stock, for every penny the stock moves, you'll know how much you're going to make, gain, lose. Also, the same thing goes for every 25 cents, 50 cents, $1, whatever. So we're going to times that by 0.01 and we get $2. Alright, so if it moves a penny, I gain or lose $2. If it goes up 2 cents, $4. 25 cents, $50. So if the stock loses 25 cents, so if it goes from $5 to $4.75, I'm down $50. Okay. $1 is $200 because it's the same amount as your shares. $2, $400. So you kind of get the idea. So let's see how this could work out for you in a different fashion. So say we have $356, okay? I'm working with small numbers for small people here, and in a minute I'll also work with a big number on my next one. All right, so we got $356, right? And we want to buy a penny stock, right? So we want to buy something really tiny that might have potential to move. All right, so we're going to divide that by, say, 0.14. Okay, so we get 2,500 shares for a 14-cent stock. Okay, so if you're following me, so we bought a 14-cent stock and we have $356, as you can see on the screen. All right, we get 2,542 shares. 2,542 times 0.01 is $25. For every penny it moves, I gain or lose $25. So if it goes up a penny, that's $25. If it goes up 2 pennies, that's $50. 3 pennies, that's $150. Or was that 75? No, $75. Sorry, I'm not thinking of driving at the same time here. I probably should be driving and doing math at the same time, but it's not that hard where I'm at. All right, so say it goes up 25 cents. Well, look, we made $635. So if it goes from 15 to 45 cents, I think, yeah, something close to that, then we made $600. Or vice versa, if it goes down, it ain't going to go down 25 cents. So good thing on these penny stocks is if you have a risk there, so like say it goes down 14 cents, you're down to a penny, so it's literally at a penny, you're down your $355. And you might actually be owing them if it goes down into tenths of a cent. But most likely it'll find some type of support between there, probably bounce off the 12 or the 10 or the 5 and then come back up to your target price. So a lot of times on those really tiny stocks, it even though they look really, really ugly, if you're buying it as it's going down, it'll most likely bounce sooner or later as it hits a double bottom or tracks along the bottom, as long as you're buying as it's going down. Alright, so now we're going to go and say we have $9,509, right? Okay, so we're just doing any type of number here. Okay, so we got $9,509 that we want to spend, and we want to calculate a stop loss on a $3 and we're going to divide it by $3.25. All right, so for a $3 stop or $3.25 stop, we want to put in $9,500. We get $2,925, or shares, sorry. So 2925 times 0.01 times 0. Or not working right, 0.01. Alright, so for every penny, you're going to lose 29 cents. So, same scenario. One's a penny stock with $300. One's a $3 stock with $9,000. Same scenario though. Almost the same stop loss. For every penny, you're doing $29. Now, your risk comes down to how much you want to lose. So, say in this scenario, you only want to lose maybe $200, right? Close enough. Right, 7 cents. Okay, 7. All right, so you can only go down 7 cents before you hit your stop loss. And that's your dollar amount. Because really you got to think. When you're looking at a monitor and you're seeing, hey, I don't want to go below this line, but you're looking at it as, kind of like. I don't want to come down to this moving average, and then wait for it to bounce up. And it could go through that moving average and just keep going down, down, down. It could break that moving average and roll over. So with that, if you're waiting for that moment, but yet you've miscalculated your stop loss by saying, hey, my timing was off. I got in way too high. It came down, hit my stop loss because it wanted to hit a moving average on a longer time frame than the shorter time frame. Then all of a sudden you realize that you made a mistake, and if you didn't set your stop loss, then you could be down for $500, $600, half of your investment, So you'd really want to set a stop loss and make sure that, you protect your account, you protect your assets. You should only allow yourself to lose so much money per trade. Now I hear people talk all the time, hey, we'll lose 1 to 3%. Well, okay, what's 1 to 3%? Depending on what your shared size is and your amount, what is actually 3%, so you really have to go and do extra math there. Why not just think ahead before you even buy the stock? Wait for it to drop down to some type of support, whether it be a moving average or it be a price level. You buy in there, and then you say, I'm going to give myself X amount of dollars. I'll give myself $200, and then you go ahead and do the math out, figure out what $200 is going to be from the amount of shares you bought at the price that you bought it for, and then protect yourself by only allowing yourself to lose that much. And if it hits it, it hits it. You know what I mean? You can come back and get that later if you time your timing right and get your stop loss right, and it moves up above the stop loss and continues to go forward. From there, you can set your stop loss higher above your entry price. That way, once you're finally well above it, then you can wait. If it does come back to your stop loss, at least it'll come back while you're in the green, not in the red. So I hope that this simple math will help you out and give you some type of ability to figure out what you're willing to risk per trade. And going forward, you know, when you're making trades, think less on what the news is, what the volume is. Look at what it wants to do. You'll know if it's got volume, it'll be moving up and down, just like it won't just be sitting there, you know, waiting for the next one. If it's going flat, you'll know why it's going flat, and that's one you probably should stay away from. You know, you'll know if you're too high, if it's already starting up high and it doesn't come back to any type of support, or if it comes back to support really, really fast and it starts breaking through moving averages. So just, you know, protect yourself. Learn to protect your account, because that's the most important thing of all. All right, guys, enjoy.